SELCO Foundation is a non-profit organization based in India that is dedicated to innovating sustainable energy-led solutions for underserved communities. The organization is guided by the belief that energy is a vital catalyst for development, enhancing livelihoods, healthcare access, and education. In order to do this work, SELCO needs to unlock financing and innovate new models by collaborating with various financial institutions.
So SELCO Foundation's journey in financing has been a very interesting journey, primarily because, while we talk about the innovation in the technology space, in the social modeling space, I think the maximum innovation over the years has actually happened on the financing piece and the financial models.
But could financial models that appear to work well in the short term be susceptible to failure in the long term? You're listening to Fail Loud, a series that draws insights from failures in the development sector, brought to you by SELCO Foundation's Impact Failure platform. In this episode, we listen to Huda Jaffer, the director of SELCO Foundation, who reflects on some significant failures the organization has faced in unlocking financing.
A program that we had designed, it was a revolving fund that we had designed with 6 different NBFCs and small banks in a small state in India, which has one of the poorest lending rates essentially. So while we designed that and it went very well, in the first year and the second year, and suddenly you realize that finance is truly a silver bullet. Once that was solved and people, lending was sorted, demand was taken care of, enterprises could plan their supply chain. So that was really going well. But I think very quickly the champion on the funding side also changed. So the entire model changed. In fact, what they, after the second year, somewhere mid-year, second year in the program, while the repayments were going strong, they actually said that the revolving fund as a model does not work out from a philanthropic perspective. And we needed to close the loans by converting the revolving funds into capital subsidies, back-ended subsidies, right? So again, that model very quickly, but because once you do that program pretty much ended there, right? And it did impact, I think, a few thousand end users. It did lead to good level of credit scores being increased, NBFCs being able to perform better as well in the region. But that I would also consider as one of the failures, again, because the champions and the mandates change from a lending and regulation perspective.
A revolving fund is like a loan system where money is recycled. You borrow, pay back, and the funds can be lent out again, creating ongoing support. In contrast, capital subsidies are one-time grants that provide immediate help but don't encourage future investment. The main difference is that revolving funds promote sustainability, while capital subsidies offer a temporary boost.
So earlier when we started working on unlocking finance for solar solutions and climate smart solutions, we primarily were looking at the demand side unlocking. So which means we would identify end users, we would see what the gaps are, we would go to banks and work with banks. But I think very quickly we realized that it's not just this space, there's also enterprise financing that needs to be supported. And even this space needs to be looked at a lot more holistically and parallelly. Just to give you an example, earlier on we would take up programs for training bankers and training financing institutes. And, once we would do that, the banks would say, yeah, okay, we are ready now. Where are the cases, right? So we sort of realized that it cannot be either or, it cannot be only one. We parallelly need to work on strengthening both supply and demand side in a very holistic manner, enterprise, the banks and the end users. And within that mix, I think the most recent addition that has happened is also ensuring that we bring in the government schemes and subsidies within that mix, because that actually can further facilitate gap finance and bank finance, because most of the schemes are actually routed through the banks itself. To give you a kind of more broader zoomed out perspective of why the failures happen, largely unlocking finance is a result of having champions on both ends, which means the person who's trying to unlock the finance and the person who's providing the finance, right? You need to make sure that they both are champions to want to make sure that this happens and there is repayment, and so that there is further on lending and further scaling of the model, right? But what ends up happening is when the key champions move around or they shift, That's why you mostly have failures that happen. Or what ends up happening is if the key champions haven't fully understood what it takes to make a program work, financing program work. So in many places where we've had bankers move who were champions, and then we've had new bankers come in, of course there has been a failure. In certain places where we've had complete disasters happen and therefore repayments not happening, those things don't end up replicating.
SELCO Foundation's experience with financing models teaches us valuable lessons about the importance of adaptability and stakeholder alignment in sustainable development. The transition from a revolving fund to capital subsidies highlights the need for continuous investment strategies that foster long-term sustainability. By understanding these dynamics, we can better navigate the complexities of financing initiatives that truly serve underserved communities. SELCO Foundation invites organizations and individuals to come forward and share their impact failure stories and to fail loud.